So it's the end of December. The holiday dust is kind of settling, and the
Yeah.
market is, well, it's unusually quiet.
Very quiet. It's thin volume, classic holiday trading.
Right. The Santa Claus rally window is technically open, and yet you look at the S&P 500, and it's just hovering right near this massive, almost hypnotic number, 7,000.
It is, and it's so easy to get caught up in the intraday noise. But if you're listening to this, you're not here for that.
No, you're here for the signal.
Exactly. Our mission here is to do a real deep dive, to look right over the fence into next year and pull out the most important signals for 2026. We're looking at the research, the consensus, to figure out where growth is sustainable.
Where the AI hype maybe ends and profit begins.
And the hidden trends that are going to define the year ahead.
Welcome to everything you need to know about finance.
And we should probably mention right up front, this deep dive is purely informational. It's based on market research and analysis.
It is absolutely not financial advice. And look, if you find this kind of content interesting, please take a second to like and subscribe. It really does ensure we can keep bringing you these deep dives. Okay, so let's set the stage just briefly. We're in late December 2025. Stocks are resilient, but they're trading in these really tight ranges.
And it's such a stark contrast, isn't it? I mean, think back to 2022, 2023.
Oh, yeah.
Where inflation was this monster in the room and the Fed was just hiking aggressively.
That whole era of high inflation anxiety seems to be receding.
It is. The market's confidence today, it's really underpinned by cooling inflation and, pretty strong corporate earnings. We are focused entirely on the future path of interest rates.
So the market has already baked in a bunch of Fed rate cuts for next year.
A significant number, yes.
So if the cuts were already priced in, why does everyone care so much about these upcoming Fed minutes? They're due out on, December 30th?
Because the market needs confirmation. It needs to see the pace and, more importantly, the unanimity of the plan. When the Fed cut rates late in 25, it signaled a shift. But policymakers often disagree on how quickly to move when you're balancing slowing inflation with keeping the economy going.
If those minutes show some dissension.
Exactly. If they suggest a slower path of easing than the market expects, say rates settling a little higher than hoped, yields could shift really quickly, and that directly impacts the valuation of every single company.
That sets the stage for 2026 perfectly. So let's shift from these short-term jitters to the long-term macro frame.
Right.
What's the fundamental investment environment next year?
Well, the 2026 frame is just fundamentally different. We're moving into a world with lower, but still kind of sticky, inflation.
Okay.
Rates are slowly drifting down, and this is critical. Continued high government spending. We're talking AI, green energy, defense, infrastructure. A lot of it.
So if rates are drifting down, is the consensus just relying on multiple expansion, or is it all about earnings growth? What does that mean for returns?
The consensus is relying heavily on earnings, which means returns are going to be so much more selective and uneven.
So you can't just buy the index and ride the wave up like in the past few years.
No, not at all. Success is going to be driven by actual fundamental performance, real business execution. The rising tide is only going to lift the boats with solid hulls this time.
Let's get specific then. The institutional forecasts seem, bullish, but definitely more moderate. We're seeing analysts eyeing an S&P 500 range of, 7,500 to 8,000 by the end of 2026?
That's the broad range, yeah.
What needs to happen for us to actually hit those numbers?
Two things, really. First, corporate earnings growth has to materialize at the high end. People are projecting around 15%.
That's a big number.
It is. And second, the Fed needs to settle its target rate in that expected 3.0 to 3.25% range. That gives companies a lower cost of capital, which in turn justifies higher valuation multiples on those strong earnings.
And you've got some high conviction players like UBS projecting 7,700, and that's based on a more conservative 10% earnings growth. But here's the challenge, right? The massive headwind against all this is market concentration.
That is the central glaring risk. We have seen it for years now. The S&P 500 is so heavily weighted toward the top 7, maybe 10 tech giants.
Which is why you have firms like GMO sounding the alarm. They're arguing the S&P is more likely to be down than up in 2026.
And that sounds so dire, doesn't it?
It does. I mean, if the rest of the economy is holding up, why are they so cautious?
It's purely a function of valuation. It's not a recession forecast. It's a warning about the really high price tags on those AI-heavy mega-cap names.
So even if the rest of the market does okay.
Exactly. If those expensive leaders just stop climbing, their massive weight could drag the entire index sideways or even down, even if, the cheaper, broader parts of the market are doing well.
So the key insight is that earnings growth has to broaden out.
It must broaden beyond a handful of winners. If it stays concentrated, the index faces a really difficult path.
That idea of broadening success, it leads us right to the biggest driver of selective growth, which is AI. We're at this critical inflection point.
We really are.
We're moving from the infrastructure phase, where it's just about buying chips and building tools, to what people are calling the productivity phase.
That transition from buying to using is everything for 2026. AI stops being the speculative story and it becomes a margin discussion.
A margin discussion, I like that.
Investors who are rewarding companies for just spending massively on infrastructure are now demanding proof. They want to see that those billions are translating into measurable operating leverage.
Meaning you have to show that AI is actually leading to higher profits or lower costs, not just headlines.
Precisely.
So the focus shifts to who can successfully embed AI into their actual business. Who are the likely winners in this new phase?
You want to look for companies with proprietary defensible data. That is the real moat now. And those that can embed AI into huge existing revenue streams.
Like enterprise software?
Enterprise software is a perfect example, especially in complex fields like legal services, health diagnostics, advanced coding platforms, and of course the core building blocks, semiconductors, data centers. They're still essential.
And on the flip side, we're going to see a shakeout. A lot of the noise is going to disappear, right?
Absolutely. The market is going to punish the AI wrapper companies, the startups that just slap an AI logo on an old business model. Anyone burning cash without a clear path to margin expansion is in trouble. Discipline is the new mandate.
Okay, we've focused entirely on the digital side, chips, software, data. But what are we overlooking in the physical world? What could actually constrain this whole AI boom?
That is the fascinating missing piece, the energy bottleneck. We have the chips. The software is getting better every single day, but these massive AI data centers require just enormous amounts of stable baseload power, 247. And the current renewable grids alone, they often struggle to guarantee that.
And this is why we're seeing this quiet but really significant nuclear renaissance.
Precisely. Governments, major infrastructure players, they're all recognizing that AI's demand for electricity is an existential challenge, and that's fueling this renewed interest in nuclear power.
And for 2026, the discussion seems to revolve heavily around SMR's small modular reactors.
It does.
Can you just quickly define what those are and why they matter for AI specifically?
Sure. SMRs are smaller advanced reactors. They can be built in a factory and deployed much faster with a smaller footprint than the giant plants we're used to. They matter for AI because they offer stable, localized, carbon-free power right where new data centers are being built.
So no decade-long construction timelines.
Right. And you're seeing names like Nuscale and Oklo gain traction, but it's what people call a grind-up sector. Slow, steady capital rotation driven by signed contracts, not by explosive tech hype.
Okay, so moving from the necessary infrastructure of today, let's pivot to the infrastructure of tomorrow. Quantum computing. This is definitely not a 2026 revenue story. It's something much further out.
It is firmly a 2030-plus infrastructure story. But 2026 will still bring major technical milestones. We need to watch for the deployment of 256-qubit systems, especially from leaders like IonQ.
And the transition to what? Fault-tolerant computing?
Yes, that's the critical step. It just means minimizing the errors that plague current quantum systems. Without that, it's just a lab curiosity, not a commercial tool.
Okay, but if the revenue is so far out, that raises a really important question about the valuations we're seeing right now in these pure-play quantum stocks.
It raises serious alarms. Analysts are explicitly warning that companies like IonQ, D-Wave, Rigetti, they're sitting in a valuation bubble. The promises are massive, but the commercial revenue is lagging badly.
And if that gap continues,
we could see a 50% correction in those stocks next year. You have to treat them like early-stage biotech.
High volatility, very patient capital.
Exactly. You're betting on the technology, not on the 2026 earnings report.
Okay, let's shift from deep tech to an asset class that's already seeing a massive infrastructure change. Crypto. The prediction is that 2026 is going to break the traditional 4-year halving cycle. How?
It's all about the institutional era. The old cycle was driven by Bitcoin's supply shock, the halving, and these bursts of retail euphoria.
Right.
But now, with Bitcoin and Ethereum ETFs fully integrated, 2026 is poised to see this continuous, consistent flow from advised wealth, from institutional treasuries.
So it's a constant demand, not just sporadic retail mania.
And that's what breaks the cycle. It treats Bitcoin more like a genuine macro asset tied to global liquidity conditions.
Okay, so higher, more stable valuation floors. What kind of price targets are tied to that?
The targets are pretty wide, but they range from about $120,000 to $150,000 for Bitcoin, especially if we get more regulatory clarity in the US.
And beyond Bitcoin.
The action is moving. Solana is expected to evolve from, a meme coin hub to a center for DePIN, decentralized physical infrastructure.
DePIN, that's a term that needs a bit more context. What exactly is being decentralized here?
DePIN involves tokenizing real-world physical assets and services. So think decentralized 5G networks, or data storage, or even energy grids. It's using crypto incentives to build and maintain physical infrastructure that's owned by a community, not one giant corporation.
Which brings us back to our earlier point about value creation. We're seeing this fat app thesis emerge.
That's the perfect synthesis of this whole maturation theme. The fat app thesis just says that value is shifting away from the blockchains themselves and toward the applications built on top of them.
The apps that actually generate fees.
The apps that have users and generate real, measurable transaction fees, proving they have product market fit, that's where the money will flow in 2026.
So let's pull all these threads together. From AI demanding operating leverage to crypto demanding application fees. The overarching kind of hidden theme seems to be capital efficiency.
That is the ultimate differentiator. The market is fundamentally shifting what it rewards across every sector. We're moving away from the question, can you grow fast at any cost, to the critical enduring question, can you grow profitably with financial discipline?
And what does that discipline actually look like for investors? What should they be looking for?
It means strictly rewarding companies that generate strong free cash flow. Companies that aggressively control their costs and actively return capital to shareholders. It is the end of the growth at all costs era.
So it's fascinating. The true winning trade might not even be the flashy tech company.
It might not. The core trade for 2026 might be the foundational infrastructure that just keeps the lights on. Electrical grid equipment, massive battery storage, the utilities managing the power.
The boring stuff.
And as a final high-stakes marker for 2026, the race to $2 trillion. Experts are tracking who will be the first new name to hit that milestone. Who's the favorite?
A lot of experts are pointing to Meta platforms.
Yeah.
Which is just a remarkable turnaround story, isn't it?
It really is.
They have this combination of massive ongoing AI spending for their long-term growth, but it's coupled with immediate AI-enhanced monetization of their ad business right now. They're seeing more ad impressions and higher prices per ad.
Driven by AI.
Driven by AI optimization. That dual approach gives them a slight edge over rivals who are just focused on hardware or the build-out. That turnaround story and that potential $2 trillion valuation. It brings us right back to where we started with concentration risk. You've now got the full breakdown of the macro picture, the sector risks, the hidden trends. But let me leave you with one final thought to explore. Given this cautious outlook on concentration, and seeing a company like Meta potentially hitting $2 trillion based on AI-enabled monetization, how long can the market really reward AI potential before it demands concrete, measurable profitability across the board, even from the biggest names? What happens when the margin discussion hits the valuation of the infrastructure builders themselves?
That's the question.
We hope you've enjoyed this deep dive. Make sure to try out our latest episodes for more deep dives into the topics shaping your world. We'll see you next time.